Good afternoon, everyone. This is Joanne Stevens, and this is our weekly call-in show. Today, our guest is Erik Hanson. Erik is an MAI appraiser. He owns his own firm, Midwest Appraisal Group, and I'm going to introduce Erik here in just a moment, and we're going to talk about what is happening with the value of these properties, why people get appraisals, and for what reasons. So those are just some of the topics we'll be discussing. I wanted to remind people that November 1st, 2nd, and 3rd is the annual National Communities Council meeting in Chicago. There are many tremendous speakers for this event. It's at a Michigan Avenue Hotel, and it's really a not to be missed event. So if you go to my website, joannemstevens.com, that's joannemstevens.com, and click on Save the Date in the upper right-hand corner, there will be information on the NCC event. That's the National Communities Council, and you can register on that site or learn more about the event. I also wanted to remind people that all of our newsletters for the real estate or for the mobile home park owners are on my website, and that's joannemstevens.com. You can read them online. You can download them. If you would like to have a newsletter mailed to you or to someone you know, just let us know by email or a phone call. We'll be glad to put them on the list. It's a free newsletter, and it's for mobile home park owners. There's a fairly new newsletter that's come out this year called the Manufactured Housing Review. And it's an excellent newsletter. It's produced by Kurt Kelly of Mobile Agency, and that he's an insurance broker, and he sells insurance for mobile home parks and mobile homes in most states in the U.S. And if you would like to get that online newsletter, just send an email to staff, STAFF, equal, the equal sign, manufacturedhousingreview.com, and you can be on the list. It comes out once a month, and it's really excellent. So those are the announcements, and I wanted to interview Erik Hanson because, first of all, Erik is an MAI appraiser, and he's going to tell us a little bit about what the difference is between an MAI appraiser and other appraisers. But I can tell you, as a real estate broker who's been in commercial real estate and in mobile home park brokerage for many years, that an MAI appraiser, that's like the PhD or the doctorate of appraising. It's the highest level that you can get. It's there's a division of the National Association of Realtors that offers the designation, and it's a very, very rigorous course, many courses, many reports, and it's there aren't that many MAI appraisers. So when you work with an MAI appraiser, you're working with somebody who really knows what they're doing. And also, Erik has been an appraiser since the year 2002. He has offices in La Crosse and Madison. He's and the way I know Erik is he's appraised a lot of parks that I've been involved in, and he really knows what he is doing. I have nothing but respect for Erik Hanson. So, Erik, are you with us?
Yeah, I'm here, Joanne. How are you today?
Well, so far I'm okay. How about you?
I'm doing really well, thank you.
So, there's been a lot of sales of parks in the Midwest where you specialize, Erik. And do you think that Well, first of all, tell us a little bit about the MAI appraisal. What's the difference between that and other appraisal designations, or are there other appraisal designations?
There are some other appraisal designations, and I'll back up a little bit. The MAI designation is awarded through the Appraisal Institute. The Institute also orders or gives other designations such as the SRA, which is for residential appraisers. They award some review designations, etc. And there's some other designations through the realtor groups and some other organizations. You kind of touched on the points that I wanted to make with the designation. It's not required, it's not licensed by the states, but it's above and beyond any state licensing that any appraisers may have. Excuse me. So basically, it goes above and beyond the typical appraiser base of knowledge and experience. So generally, when you hire an MAI designated appraiser, they've got a little more experience and knowledge than the typical appraiser does. And I'll give you an example. There's maybe about 70 MAI designated appraisers in the whole state of Wisconsin. I'm not sure what the national number is, and of course, Wisconsin is kind of small compared to some of the other states. But the moral of the story is there's not a lot of us out there.
Sure. And as I'm a commercial real estate agent, and so when I list a park and get the park sold, we know that there's going to be an appraiser that the bank is going to need to hire. And so that's most of my experience with, we have to have an appraisal on the property to, for the lender to make sure the property appraises for what it's being sold for or purchased for. But there's other reasons why people get appraisals, are there not?
Yeah, and of course the most common would be for a sales transaction or a basic refinance of the loan is coming due, and perhaps the owner wants to pull out some equity to make some improvements or to buy another park. Some of the other things we see, the need for estate planning, such as a person passing away. The estate needs to figure out a base for tax purposes, what the park is worth on the date of passing. We also have done some appraisals for partner buyouts. One partner might be retiring or moving out of the area, those type of things. So we need to figure out what the whole park is worth, and then also what the fractional interest might be worth. So those are kind of some of the more unique situations, but most of what we do is for the purchases or refinances.
Sure. And with the partner, the fractional interest, you're talking about if a partner wants to sell just his interest, but the other partners, they're not really selling the park and going out to sell going out to the market to sell the property. Is that right?
Typically, the remaining partner or partners or family members would buy the fractional interest, but there's occasions where an outside buyer might be brought in to buy out the position of a member who no longer wants to or needs to be a member of that ownership group. So I've seen it both ways. Most typically, the existing partners buy out one or more partners.
Mm-hmm. Okay. And Erik, it seems like in the last 10 years or so, we're getting into more specialization, for sure in real estate, and I'm noticing that in the appraisal world too. And what I mean by that is, I think there was a time when there probably weren't too many real estate brokers who specialized in selling one thing, such as I sell mobile home parks, but you have, real estate agents who specialize in new home construction or luxury homes or vacation homes or condos, and commercial real estate agents that specialize in apartments or office properties. And so you primarily do mobile home parks. I know you appraise other commercial real estate also, but why does it make a difference to hire an appraiser who's has had a lot of experience in appraising mobile home parks?
Yeah, I'll kind of answer that in two parts. The first part, why would an appraiser choose to specialize? A couple things there. One, it may be a geographic advantage. For example, if an appraiser lives in an area with a significant number of waterfront properties, it might make sense for them to become specialized in high-end residential waterfront properties. Another reason, technology has changed so much in the last 10 to 15 years, and the availability of data has allowed for more appraisers to do a lot of different property types. For example, there's so much data out there now on triple net leased retail buildings that almost all appraisers can have access to that data. So almost all appraisers can figure out how to appraise that. The specialty comes in when you have property types where there isn't significant data readily available, or an appraiser doesn't know where to get that data. That's where some of the specialists come in. I can give you a kind of a horror story of a recent example. A couple weeks ago, a property owner contacted me. He was trying to refinance two mobile home parks, and the bank had called us, and we put in a bid to appraise those two parks, and they sent an email back and said, well, we decided to go with someone else. They were a little bit cheaper and could do it a little faster, so we're going to go with another firm. It didn't end so well. The appraiser completely messed up the deal. He undervalued the park. Basically, it was a competency issue. He didn't know what market rents were, didn't have the ability to analyze actual expenses, had no idea a correct range of cap rates for that particular park, given the location. And the report showed that there was a complete lack of data and understanding. So the end result was the income was too low, the expenses were too high, and the cap rate was too high. So the value that he put on the park was way below where it should have been, several $100,000.
Oh my gosh.
So the bank, by attempting to save their client a few dollars on the appraisal side, ended up costing him hundreds of thousands of dollars. I think it was probably somewhere in the $600,000 to $800,000 range. So that's kind of an extreme example, but we see that happening a lot. And I know this appraiser does not appraise a lot of mobile home parks, so he just doesn't have access to good data or resources to figure out what things are actually worth.
Yes, there's a lot to know about mobile home parks, and so it does take expertise without a doubt. And that is a horror story, because a lot of the buyers who buy the mobile home parks, they do make improvements, or they improve the bottom line in a relatively short period of time, as you know, either through being really careful with the expenses, maybe raising the rent a little bit, or passing through the water and sewer, garbage, this type of thing. And so one of the reasons that they do that is so that they can refinance the property and buy another property, or do something that, for their investment goal. So that is a very that is a horror story. Hopefully oh, go ahead.
So it messed up that deal, but it also messed up potential future deals that particular investor was looking to get into with that equity that should have been there.
Exactly. I have a similar story that a park owner had his park appraised, and I think it was somebody who maybe had appraised one or two parks over a 10-year period. And anyway, when they did the appraisal, it came in way high, much higher than what it would sell for. And what happened was, in doing the appraisal, the park was about 1/3 vacant, and so the appraiser counted all of the income, or 95%, as if it was 95% occupied, because one of the kind of rules in some real estate is a 5% vacancy factor, even if it's 100% full, with the idea that, well, not everybody's going to pay every month. Or you're going to have some vacancy, turnover, this type of thing. Anyway, the park owner now feels that that's the value. The appraiser appraised it. Well, that must be what it would sell for, and that's not necessarily the case. So he now fully expects to get that higher price, and today people aren't really paying for those vacant sites. But we're starting to see exceptions, aren't we, Erik? Or how do you value vacant sites? I get asked that question a lot. What do you think?
And it really kind of depends on the market. If there is strong market demand in that area, buyers will tend to maybe, I would say, overpay based on the current income, because there's such a huge potential to fill the vacant lots that the current owner may not have the resources to do, or may not have the drive to do. We've seen situations where maybe the mom and pop owner just don't have the ambition anymore to bring in a bunch of homes and get the park filled up. Certain situations, it makes sense to value the park as is and value the park at a future time period. If there's a significant number of vacant lots that can be filled relatively quickly through the cash program or those type of things, it makes sense for us to look at it and say, here's what it is as of the date of inspection, and here's what we think it's going to be a year or two down the road.
Okay.
Now, one thing we don't really get into anymore is doing the discounted cash flows with projections 5 to 10 years out. The crash kind of shied us away from those, because I can imagine a discounted cash flow done in 2007 with a 10-year projection probably was nowhere close to where it actually came out to be. So I know there's some appraisers that still do those, and certain properties that have built-in long-term leases with rent increases, that might make sense. Mm-hmm. But we tend to shy away from those on the mobile home parks. So really, you have two values. You have as is, and then you have a future date, and what is somebody going to pay for that right now? Is it just what it's worth now, or will they give a little bit of credit for that big potential increase in value in year 2 or year 3? And we've seen it both ways.
And so the projection of the value based on, whatever you project those things to be, and what the value might be in year 2 or year 3, is that is that the discounted cash flow?
We would basically do two analysis. We do a straight cap rate on both income streams, and then reconcile the difference based on what we think it's worth today. So we would do an as is, and then maybe a year 2 projection with lots filled and increases, things like that. Let's just use some real basic numbers. Let's say based on the cash flow today, it's worth $1 million. If an investor buys it and fills a number of lots and raises rents, let's say in year 2, it's worth $2 million. Now that upside is pretty significant, but would an investor today go in and pay $2 million? Well, of course not. They have to do the legwork to get that park filled. But maybe there's enough of an upside that maybe they'd pay a little higher than $1 million. Maybe it's $1.1 million, $1.2 million, $1.3 million, and there's still a significant upside, and then they get that park locked up. But we've also seen it where the upside is so challenging that they might even pay less than what it's worth based on current income. There's significant capital improvements that needs to be done. The park is just in really, really rough shape.
Sure.
So I've seen a number of different scenarios there.
It sounds like what you're saying, Erik, is that the park value, the appraised value, is not the same value for everybody. In other words, you make some assumptions if there is deferred maintenance or if there are vacant sites, things that are going to cost somebody money and effort, resources, a lot of marketing time and ability. If the new buyer does buy the park, buy new homes to fill the sites.
Yeah, I would agree with that. The park may be worth different to different buyers, and what we attempt to do as appraisers is report what the market would do with the subject property. And by that I mean we're interviewing buyers and sellers based on the data we find and the improved sales and the rent comparables we verify. Where should this thing realistically be at? Based on what market would pay for it. So it's not always just what does it look like on the surface, and we need to dig a little deeper. And that's part of the knowledge of the appraiser and the ability to get that data to make sense of what's there.
Sure. And when you do, when you get the call either from the park owner or the bank to do the appraisal, what do you need from the sellers? I'm always, sellers sometimes don't like to hear me say this, but they need to have rent rolls, and they need to keep track of their expenses, their actual expenses that are only pertain to operating the property. But what kind of records do you expect to see when you had the assignment to appraise the park?
Yeah, some of those same things. We always want a current rent roll, and we want that rent roll to differentiate between lot rent and park-owned homes, if there is a few of those in the park. So we need to know which ones are park-owned home, which ones are tenant-owned homes, the different lot rents. We like historical income and expenses for at least 3 years, if that's possible. One of the things that helps us do, if the park is on the upside, especially income-wise, is we can show a historical trend of where it's been and where it's going. So when we make some projections based on a lot increase, there's some data there to back that up. A lot of times we'll see P&L statements. We'll also see tax returns, as long as all the information is there, not just page one of the return that shows other expenses or other income. We need to know what those things are, and do they really pertain to the park, or is there some other things lumped in there that we need some explanation on. We also we're required by our standards to analyze any purchase agreement. So sometimes we'll get situations where they don't want to give us those, and that's always kind of a red flag, because it's a pretty common request, especially on a purchase. But I think sometimes there's such a good deal that they don't want the appraiser to be influenced by what they're paying. And realistically, we shouldn't be. We should do it independently, and the value is what it is, regardless of what they're paying. So those are a few of the things that we like to see. And any other data pertaining to the park, if there's a park layout or a survey, we can get flood maps. That's easy enough to get those. A lot of times we can get some assessor data on any of the improvements that are in the park, such as an office or storm shelter, things like that. So those things aren't as critical as the financial side of things.
Sure. And when you're appraising, you mentioned on the rent roll showing that to break out what is the lot rent and what is the home rent if there are park-owned homes. Do you get into value? How do you value the homes if the park owner is selling some of the park-owned homes, or owns the homes and is selling those with the purchase?
Sure. Occasionally we will value park-owned homes, not very often. In most cases, the lender doesn't want that. If it's a sale, a lot of times the seller will carry back a note for the park-owned homes. Most lenders I know carry homes as a personal property or as basically a signature loan with a higher interest rate than the real estate. If we're required to, what I do is I break out the home income above and beyond the lot rent. So for example, if the total rent is $600 and the lot rent is $200, we've got $400 a month for the actual home. And then what we've come up with is there's some ways to look at that income. When you have a pretty good sales database like we do, a lot of times we'll see sales that there's some park-owned homes involved, and those buyers and sellers allocate a certain amount for the park-owned homes. So we're able to draw some income multiplier data from those sales to apply to our subject. And a lot of times it really makes sense with older homes that might be in the, let's say, $3,000 to $10,000 range. When you get more expensive homes, the rents don't always appreciate with the value of those homes. So sometimes those higher end homes, it just doesn't make a whole lot of sense. But the few cases we've done park-owned homes, it's been, I would say, $3,000 to $10,000 range, so kind of lower end things, and it seems to work out doing it from an income analysis.
Sure. Yeah, that sounds like a logical way to do it and an accurate way to do it too. And so, one of the things that I hear, I wanted to ask you about city water and sewer as opposed to private utilities such as wells and septic tanks or holding tanks for the sewer system. And I get a lot of calls from buyers who want to buy parks, and one of the things that they tell me is that they don't want to buy parks with private utilities. And sometimes I think it's because that's what they've heard, somewhere along the line, that they, potentially could cost more money, which they probably can. They have to be repaired or replaced. But how do you value, or do you take that into consideration?
Yeah, we definitely do. And what I see now more than a few years ago is there's kind of more of an acceptance for private utilities, especially private wells seems to not be that big of a deal anymore. The concern is more on the private septic or the packaging plants or the lagoon systems, more maintenance and expense on those type of things.
Okay.
So really, when we look at it from an income standpoint, if you have a packaging plant, typically you have to have a licensed operator to test your discharge and those type of things. So there's some expenses already built into your operating statements for that. What we also look at is what we call a replacement reserve, which is money set aside for capital expenditures, because we know at some point we're going to have to replace that septic system, or at the minimum maintain it. So there needs to be some money put aside there. So we look at it from an income standpoint and try to estimate, well, if that packaging plant has a 10-year life remaining, what do we need to put away every year to make sure we have enough in year 10 to replace that system? And that can get a little gray, as far as cost, but it kind of gets us pointed in the right direction. So it's basically taking some of that income and allocating it for those replacements. So that's how we handle it from a valuation standpoint. But I would definitely say that there's more acceptance now for private utilities than there was a few years ago. And I think a lot of that has to do with just the overall demand for parks and the lack of supply out there.
Mm-hmm. Yes, I can see that happening. And I would agree with you. There is more acceptance than there was, say, even 2 years ago of the private utilities. And so I wanted to ask you also, what are you seeing in lot rent trends? Because I know I've seen your appraisals, and you do study the lot rent comparables. Are you noticing anything in terms of, are they flat, increasing?
I would say a general statement across the board would be increasing. We still see some smaller town parks that have remained kind of flat. And I think a lot of that is the ownership structure. They kind of know everybody in the park, and they don't really want to raise rents, those type of things. But I think generally in the metros we work in, Twin Cities Metro or Des Moines Metro, some of those larger populations, we'll see anywhere from probably $10 to $25 to $30 a month annual increase. Smaller communities, maybe the $5 to $10 a month range is pretty standard. The one thing that we are seeing more and more of now is billing back for water and sewer, either through sub-metering or a RUB system, those type of things. And I'm seeing that more and more, and I think people are realizing that, investors that is, that we can basically eliminate most of this water and sewer expense and trash too, by passing those expenses back to the tenants. And what I've seen is the owner will forego, let's say, one annual lot increase, and in that year they will bill back water and sewer and skip the lot rent increase, and then continue with that in year two. So then it appears as if it's a minimal increase overall, rather than doing lot and water and sewer at the same time.
Sure. What I wonder sometimes, Erik, is real estate. Most park owners or many park owners tell me how much their real estate taxes are, and they seem to be rising. I wonder if at some point we'll see some sort of at least a partial pass through of real estate taxes.
I'm not sure, and we appraise in about 5 states now, so we see a little bit of everything. Iowa is assessed by the county, so typically every park in the same county is going to be assessed around the same value per site. When you get into Wisconsin, the assessments are done by each township or municipality or city. So they are really all over the place, and we honestly never know where the assessments are going to be at. We've seen where parks are purchased well above the assessed value, and the assessed value doesn't change. Other times the assessed value goes up 50%. That's the one kind of wild card when you buy the parks, is where are those assessments and taxes going to go, and that's kind of the great unknown there.
Yes, and so when you're doing the appraisal, and if the property sells at the price that it's under contract for, do you take into account, or do you work that into your number as a potential increase in the real estate taxes?
Yes, we do, and it does depend on how far off our estimated value is from the current assessed value. If there is a large gap and it's for purchase, likely we are going to estimate an increase. If it's not a large gap, generally we'll leave that alone. But I think the lending side of it, the bankers are going to probably expect an increase in taxes because they see the tax bills just like we do, and they realize the assessments are low. And a thing I'll say about the assessment side of it, generally the assessors assess all property types, so they're not out there necessarily looking for a bunch of mobile home park sales when they're assessing the office buildings and the apartments and every other property type. So they don't always necessarily have all the same data that we have. So I'm not trying to sit here and say, well, the assessors don't know what they're doing. I'm not saying that at all. I'm just saying they don't necessarily have the same things that we have.
Sure, they're not drilling down as much as you are to thoroughly understand the marketplace and the property. And so I'm going to ask you one more question about vacant sites, and then I'm going to ask you to give our listeners your contact information of how they may reach you if they want to talk to you about an appraisal for their park. So are you noticing anything different in the vacancy? Is it about the same as it was, say, 2 or 3 years ago, or are more are more sites getting occupied with, say, new homes, or anything that you're noticing, Erik?
Yeah, I would say more sites occupied with new homes. I mentioned that cash program through 21st Century Mortgage.
Uh-huh.
A lot of park owners are taking advantage of that. There's a lot of information online. I don't need to give the whole rundown now, but basically it allows for a very reasonably priced way for owners to fill sites and either rent or sell those homes to tenants. So we're seeing a lot more new homes moved in parks, which of course makes the park just look nicer on the surface, and just kind of has a newer, nicer look. So that's a good thing in my opinion. And the parks that are kind of stabilized, they've been kind of stabilized. I haven't seen a massive, exodus of tenants in any of the parks we've looked at in the last few years. And one big reason I think for that is the still severe lack of affordable housing. We're seeing apartments constructed everywhere we go, and these apartments are very, very nice. Lots of amenities. They've got the pools and the workout areas and all these different things, and it's a real competition between these different apartment owners. But this is all increasing the prices of apartments.
Yes.
So there's really, the gap is widening between what you can buy a mobile home for and put it on a lot versus what you can rent an apartment for, and that gap I think is going to continue to widen. So I think there's going to be more and more demand going forward for the mobile home sites.
For the mobile homes, yeah. And it'll be interesting to see if we see any new park development. Well, I want, Erik, tell people how they can reach you. I know you have a website, and so tell us your website and your email and your phone number, if you would, please.
Yeah, website is mhpappraisal.com. mhpappraisal.com, and email address Erik, ERIK, at mhpappraisal.com. Phone number 608-279-1164.
So I highly recommend, Erik, if you need an appraisal for your park. And so I want to thank Erik for being our guest today. I learned a lot, especially about, how the homes are valued, and about the public utilities, city water and city sewer versus the private utilities. That was very informative. And also the what an mobile home park appraiser that's appraised a lot of parks, what they can bring to benefit either the bank, the purchaser, the owner, or the estate, or there's many uses. So thank you, Erik.
Yeah, thanks, Joanne. I appreciate your time, and hope the listeners learned a few things today too.
Okay, thanks so much. We'll talk again.
All right, thanks, Joanne.
Okay, thanks everybody. Talk to you next week.